Imagine walking into a corporate boardroom, right? You're standing in front of your executive team and you pitch your brilliant new growth strategy.
Oh, this should be good.
Yeah, you tell them, next year we need to sell millions of dollars less in product.
Right, which is just wild.
Exactly. I mean, in almost any traditional industry, security would be escorting you out of the building.
Yeah, they'd think you lost your mind.
We are so conditioned to the volume game, you know? More products, more stores, more customers. The chart always has to point up and to the right.
Always.
But when you step into the high-stakes, kind of ruthless and intensely psychological world of luxury fashion, that conventional playbook just gets totally shredded.
It really does. It's a phenomenal paradox, honestly. We are examining the deliberate, mathematically engineered process of shrinking to grow.
Shrinking to grow. Welcome to today's deep dive, everyone.
Glad to be here.
Our source material today is the Q3 fiscal 2026 earnings call for Capri Holdings Limited.
Right, the parent company behind massive brands.
Yeah, iconic names like Michael Kors and Jimmy Choo. And our mission for this deep dive is to decode the anatomy of a huge corporate turnaround.
And it is a complicated one.
Very. We are going to unpack exactly how a fashion empire tries to regain its exclusive luster, while navigating shifting consumer tastes, tariffs, and a massive restructuring.
Because to fully grasp what Capri is attempting, you really have to look at the mechanics of the luxury sector right now. It's incredibly polarized.
It is. And for you listening, whether you're an investor looking to understand retail mechanics or a marketer curious about Gen Z engagement.
Or just someone wondering why that Michael Kors bag suddenly costs a little more, right?
Exactly. Why it costs more and is on sale a lot less. This deep dive will give you the ultimate behind-the-scenes look at the business of desire.
I love that phrase, the business of desire.
Right. And to do this right, we are structuring our analysis around 4 key pillars today.
The standard playbook for our deep dives.
Yep. First, the headline numbers. Revenue, EPS, how they stack up. Second, the story behind those numbers. Third, management guidance for the future. And finally, the bottom line.
Are we bullish or bearish on the stock? Basis?
Exactly. But the narrative today actually starts in a really surprising place.
It does.
Because before a company can aggressively invest in its future, it has to fix its foundation. So we are starting not with what Capri is selling to consumers, but what they just sold to Wall Street.
Right, which was Versace.
Versace. They finalized the sale of the Versace brand, which is a massive deal.
It's a huge deal. It resulted in a $1.4 billion cash injection.
$1.4 billion.
Yeah. And to understand why that matters, you have to look at the balance sheet heading into the quarter. They were carrying $1.6 billion in net debt.
Which is crushing. I mean, carrying $1.6 billion in debt in a fluctuating interest rate environment, you're not playing offense at that point.
No, you're playing pure defense. Every single decision, from marketing to the supply chain, is filtered through the anxiety of paying that debt.
It totally paralyzes creative risk-taking.
Exactly. So by offloading Versace, they bought themselves the ultimate corporate luxury, which is flexibility.
Wait, let me get the exact numbers on that flexibility.
Yeah.
So they take the $1.4 billion from the sale,
right,
and they apply it to the $1.6 billion in debt.
Yep. So net debt plummets down to just $80 million.
Wow. From $1.6 billion to $80 million, that completely transforms the balance sheet.
It's night and day. In the earnings call, they literally excluded Versace's financial results and treated them as discontinued operations.
But let me push back on this a little bit.
Sure.
Because carving out a legendary brand like Versace to fund Michael Kors, it feels a bit like selling a Ferrari to pay off your mortgage so you can, renovate your kitchen.
That's a funny way to put it, yeah.
It's practical, but does it strip the company of its highest end prestige?
Well, see, that assumes the holding company's prestige matters to the end consumer.
Which it doesn't?
Not really. The 22-year-old buying a Michael Kors bag doesn't care about the corporate umbrella. What matters to Wall Street is capital allocation.
Okay, that makes sense.
Keeping Versace while suffocating under debt would mean starving all their brands. It wasn't a fire sale. Management called it a thoughtful decision to strengthen their financial foundation.
Right. So now, with the debt essentially wiped out, Capri has the capital to aggressively fund store renovations, digital tech, marketing.
Exactly. for its remaining anchor brands without crippling interest payments.
Notice how corporate strategy mirrors personal finance, you guys. High debt restricts movement. Clearing it allows you to dictate your own terms.
Even if it means selling a prized asset.
Exactly. So with the balance sheet secured, let's pivot to Capri's biggest revenue engine, which is Michael Kors.
And this is where we get into the headline numbers, and they are fascinating.
Fascination is one word for it. Looking at the numbers reveals a glaring contradiction.
Total company revenue was $1.025 billion.
Which is a 4% decrease year over year.
Right. And Michael Kors specifically dropped 5.6%.
And in the Americas region, they saw low double-digit declines.
But Europe increased mid-single digits.
Okay, so the top-line revenue is shrinking. But here's the paradox. Earnings per share, or EPS, actually increased by 30%.
Up to 81 cents per share.
So how does a company make 30% more profit per share while its sales are shrinking?
It comes down to something called quality of sale and average unit retail, or AUR.
Well, let's translate that Wall Street jargon for the listeners. What does quality of sale actually mean on the ground?
It means they are intentionally pulling back on promotions and discounts.
Across both full price and outlet channels, right?
Everywhere. They're actively choosing to sell fewer items, but at full price.
It's like a popular nightclub that used to let anyone in for half price just to pack the dance floor.
Oh, that's a perfect analogy.
Right. Now they're enforcing a strict dress code and a full cover charge. The line outside is way shorter, but the people inside are spending way more at the bar. But I have to wonder, is management getting nervous looking at that shorter line?
Well, the full price channel data is what keeps them confident. Even with the overall revenue drop, they saw low double-digit increases in full-price sales.
Wow, so the people who are buying are happily paying top dollar.
Yes, but there's a painful element to this, which the CEO called out on the call. The daigou factor.
Oh, right, the daigou sales. We need to explain this because it's wild.
It really is. Daigou, or daigou, refers to bulk or gray market buying.
Basically, people coming into U.S. outlet stores, buying a ton of discounted bags, and then reselling them overseas.
Exactly. It creates a ton of volume, which looks great for short-term revenue, but it destroys your brand equity long-term.
Because why would someone in, say, Shanghai pay full price at a Michael Kors boutique if they can buy it from a reseller on WeChat for 30% less?
Precisely. So Capri intentionally reduced millions of dollars in these daigou sales.
Which creates a painful headwind right now. They expect this drag to last until August or September of 2026.
Yeah, it hurts the top line today, but it cleans up the brand's distribution long-term.
So it's short-term pain for long-term exclusivity.
Which is exactly what you want to see if you're holding the stock for a multi-year horizon. They are prioritizing margin over volume.
Okay, but it's one thing to stop putting items on sale. It's a completely different challenge to convince consumers they're actually worth paying full price for.
Right, you have to rebuild the brand heat.
Exactly. How is Michael Kors engineering that desire, especially with younger buyers?
It's all about a massive pivot in marketing. They reported a 100% increase in influencer-driven posts year over year.
100%. That is a huge jump.
And it led to a 300% increase in impressions and engagement.
Okay, so the TikTok and Instagram strategy is working.
Very much so. They launched this Hotel Stories campaign.
I saw that. It's a narrative of traveling from New York City to Banff, Canada.
Yeah, they're trying to highlight their classic jet set ethos for a new generation.
But wait, let me jump in here. We hear jet set and we think 1970s glamour.
Sure, private planes, Monaco.
Right. How are they translating an old school luxury concept for a 20-year-old on TikTok? Is the jet set today just like a highly curated Instagram vacation aesthetic?
Honestly, yes. It's the aesthetic, but tied to a very strategic product shift. They are focusing on standout style with iconic lines, the Hamilton, the Lila, the Nolita.
The Nolita pochette, I've seen that everywhere.
Because they made a highly calculated push into the $150 to $250 price bracket.
Ah, okay. The math behind the marketing.
Exactly. The Lila extra small crossbody and the Nolita pochette are precision engineered to be accessible entry points.
So a Gen Z buyer sees the Banff campaign on TikTok, they want the lifestyle, and boom, there's a bag for $195.
Right, and it's working. Their global consumer database grew by 8%.
Which is fantastic data for the CRM.
They are utilizing advanced data analytics to track how this younger cohort moves directly from an influencer's post to purchasing that Nolita pochette.
That is some serious precision targeting.
And they are elevating the physical retail experience too. Over 3 years, They are renovating 50% of their fleet.
50%. That is a lot of stores to redo.
They want a modern, warm residential design. They had reopening events at Rockefeller Center and Regent Street just to generate social media buzz.
So the physical store just becomes a content studio for the digital brand.
Basically, yeah.
Okay, so Michael Kors is in this deliberate, sort of messy transition phase, but Capri has another major brand that is actually serving as the immediate growth engine.
Jimmy Choo.
Jimmy Choo. Proving that these long-term strategies can actually work. What were their headline numbers?
Revenue increased 5%, hitting expectations.
Nice.
And management reiterated a goal of becoming an $800+ million business. Right now, they are guiding $590 to $600 million for fiscal 26.
And the wholesale channel is really strong here, right?
Double-digit growth. Specifically high single-digit increases in North American department stores.
Well, it shows a lot of confidence from the wholesale buyers.
Plus, they had that huge Sydney Sweeney holiday campaign.
Oh, I read about that. It generated 150 million impressions.
Just massive visibility. But the real story is the product strategy. They are stepping out of the stiletto.
Which is what they are famous for.
Right, the iconic Azaya sandal.
Yeah.
But how often do you buy a red carpet stiletto?
Once a year. Maybe a few times in a lifetime for most people.
Exactly. So we need to talk about the concept of lifetime value. Jimmy Choo realized that to capture the consumer's everyday spend, they have to expand heavily into casual footwear.
So sneakers, loafers, ballerina flats.
Yep. And accessories. They highlighted the bonbon and cinch groups.
They are also adjusting the pricing architecture here too, right?
Very deliberately. They're introducing bags positioned below the $1,500 mark to capture a wider audience.
But wait, if a brand famous for top-tier red carpet stilettos starts leaning heavily into sneakers and sub-$1,500 bags, do they risk losing their luxury status?
It's the classic tightrope walk between volume and prestige.
It really is. Like, does a VIP client still want the brand if everyone has their sneakers?
That's why they pair it with hyperlocal in-store activations. The Meet Me at the Bar events.
Tell me about those.
They did over 400 of these local events worldwide.
Wow, 400.
And they drove 14 million impressions. It proves that these high-touch, localized activations are crucial for high-value clienteling.
So you sell the casual stuff to the masses online, but you treat the high rollers to private bar events in the boutique.
Exactly.
Wait.
It protects the prestige while driving the volume.
That is incredibly smart. But, you know, all this glamorous marketing, the VIP events, the influencers, it ultimately has to survive the harsh realities of the global supply chain.
Which brings us to the math of fashion. Margins and tariffs.
Yes. Section 5, the wholesale ecosystem. What did the gross margins look like?
It's a tale of two metrics, honestly. Total margin fell 230 basis points to 60.8%.
Okay, a 230 basis point drop is significant.
It is. But the underlying margin actually expanded 70 basis points.
Hold on, let me make sure I understand. The business itself is healthier, people are paying full price, so underlying margins are up. But the total margin took a massive hit. Who is the culprit?
Tariffs.
Ah, tariffs.
Higher than anticipated tariff rates resulted in a 50 basis point hit to Q3 alone.
And what's crazy is that these tariffs specifically hit the new products.
Because the new products are made with different materials or sourced differently, they carried higher tariff rates.
So the exact items that are selling better and driving the turnaround are the ones getting penalized by macroeconomic trade policies.
It's incredibly frustrating for management. They are literally being taxed on their success.
So what's their plan to fix it?
For fiscal 27, they plan to offset these tariffs with targeted price increases and sourcing efficiencies.
Basically, the consumer is going to absorb some of that tariff cost, and they'll try to find cheaper ways to move the goods.
Exactly. On a positive note, inventory is incredibly lean, down 6.5% year over year.
Which is great. You don't want a ton of unsold bags sitting in a warehouse, especially when you're trying to cut discounts.
Right, but there was one other dark cloud on the call. A $15 million reserve was taken related to a wholesale customer bankruptcy.
Saks?
Yeah, the Saks Global Reserve. It is a fascinating look at B2B retail risk.
This just shows how interconnected the retail ecosystem is. You can have the best TikTok campaign in the world, the leanest inventory.
You can do everything right.
Exactly. But if the department store selling your shoes goes bankrupt, your bottom line still takes a massive $15 million hit.
Even top-tier brands are vulnerable when their distribution partners struggle.
Did management sound panicked about Saks?
Not at all. They actually expressed optimism in the new Saks global leadership.
Right. They referenced their past experience with Neiman Marcus.
Yeah, they believe the new team can navigate the restructuring, but it's a risk factor investors definitely need to watch.
Okay, so let's synthesize everything for the listener. The bottom line. Are we looking at a bullish or bearish signal here?
I'd say it's cautiously bullish for the long term, but you have to have the stomach for short-term bearish pain.
Right. We've decoded Capri Holdings' Q3 earnings, and we are seeing a company that shed a massive amount of debt by saying goodbye to Versace.
Which was a brilliant foundational move.
Absolutely. And they used that freedom to fund a calculated gamble, purposefully shrinking Michael Kors' sales volume to rebuild premium pricing power.
While simultaneously stretching Jimmy Choo into the everyday casual market to drive growth.
It is a phenomenal high-wire act.
It really is.
But I want to leave you, the listener, with a broader question to mull over, something that builds on all this data.
Let's hear it.
As Michael Kors successfully transitions away from heady discounts, what happens to the millions of consumers who relied on those outlets for their very first taste of luxury?
That is the million-dollar question.
Right. If the entry-level door to luxury closes because brands are chasing higher margins and exclusivity, does it create a vacuum?
It absolutely leaves a gap in the market.
Exactly. Does it create a vacuum for a completely new generation of mid-tier, digitally native brands to swoop in and take their place?
I mean, nature abhors a vacuum. Someone is going to sell to those Gen Z buyers if they can't afford the new full-price Michael Kors.
Exactly. The true cost of exclusivity might just be leaving the door wide open for your future competitors.
Such a great point to end on.
Thanks for joining us on this deep dive. Keep an eye on those margins, watch out for tariffs, and we will catch you next time.